So again, if you go back to, true diversification and separating out assets, and let's take, this market that we're in as a good case in point. The last 2 weeks, actually really the last 4 months, it's been all over the board. Huge swings. And let's say, for instance, you were that individual that just retired in this market. Let's say you had $200,000 or $250,000 and you needed to take 5% a year of that account. Well, 2% of that, 5% of 250,000 is $12,500 a year. Now, markets are down, let's say 5%. What did you just lock in for this month on that money that you just had to take out? That $12,500 cost you twice as much. So do you see my point? If you're all on the risk side in an asset allocation model, you're going to cook your goose in a market like this. You're locking in and locking down losses if you're living on it. Now, it's a whole different story when you're not living on it. And you shouldn't be pulling in and out of the market if you're properly asset allocated. And that's another whole topic in itself. And if you don't know what real allocation is, you need to come in and we'll show you what that really is. Mm-hmm. Because if you're sitting in all of the top Dow 30 stocks, you're totally underallocated. If you're all U.S., you're totally underallocated. That's not the way to be properly allocated if you're in the market.
And you shouldn't try and stock pick, because in our seminar we talk about why stock picking over the long run doesn't work, because we looked at the top 30 fund managers over a time period, and then you look at a different time period of those same fund managers, and they never produce the same result. So they might do well for 5 years,
right, a period of time.
The next 5 years, most certainly they're not going to do well again.
Right. So again, allocation is critical. That's why you truly diversify.